Joining us this morning, Charles Schwab, Chief Investment Strategist, Sonders. Great to see you. Just on the data, I mean, the housing number, the confidence number, are you expecting maybe a new wave of recession calls getting pushed back?
Well, Carl, we've talked about this on your program before. We think what we've been in really for a couple of years now is some version of a rolling recession. And when you look at areas like housing and maybe to a broader degree manufacturing, they went into their recession-like downturns. And clearly in the case of housing, coming out. And one of our theses around this rolling recession is that best case scenario is not really soft landing in a traditional sense, but a continuation of the roll through such that at some point that services might start to get hit. And you're seeing some cracks there and or the labor market gets hit, that you've got offsetting stability or strength in other areas, potentially like housing. And I just wrote about housing this week and posted it's on our Schwab.com, but it's also on my Twitter feed, so you can look into more detail. But that's right now a positive support, or at least an offset to some of the pockets of now either new weakness or ongoing weakness.
Right. That's what Klarman was referring to in that Biden week. And the list is sort of familiar by now with student loans, the drawdown of savings, tighter credit, maybe some rising jobless claims. I just wonder, I mean, how you're thinking of that in the second half. Which offset is dominant?
So I think claims are really important to watch, not just because they're a key leading indicator, but it generally is the first tell of further cracks that start to appear. I think there is some labor hoarding that maybe changes the backdrop in this current very unique pandemic environment, and that helps to explain resilience. But that's also why I think metrics like hours worked needs to be watched very carefully. Those have come down consistently, and if you sort of apply the methodology and math around that to payrolls wouldn't be as strong as they have been were it not for companies cutting hours work. So particularly in this next jobs report, I think you got to peel the onion back a bit and look at some of those other metrics. Another metric that has rolled over is what's generically called the job finding rate. And it just looks at the percentage of people in the prior month that were unemployed that are then employed in the current month. And I think that's a better read on the tightness or looseness in the labor market versus something like job openings, which arguably overstate actual openings relative to number of people unemployed, which I think understates potential job applicants because there are job switchers, people that are employed that are looking to do something else. So that job finding rate, I think, is going to start to gain traction as maybe a real-time indicator of looseness or tightness in the labor market.